on this and the mixed economic picture, let's welcome Jeffrey Small, president of Arbor Financial in Florida. Jeffrey, welcome. So the Fed's inflation target is 2%. We're not there. In December, inflation rose 3.4% from the previous year. What does another rate pause tell us?
Well, technically, the Fed should be congratulated. They've got their soft landings. The last 6 months, real inflation is about 1.9%. But, you know, the Fed does things a little bit differently. They look backwards 12 months and they're saying, look, we want to hit that 2% target for the American people. We believe we can do it, maybe stay a little bit higher for longer and keep rates where they are because we want to lower prices, but yet maintain the business cycle and keep employment around 3.7% on the unemployment. And so the Fed's hitting their mandates. I mean, I got to hand it to them. They're doing good. But also the economy is still fairly strong. And so it's a nice balance they're attaining here at this time. But the March rate cut, I think, is off the table.
Okay. Well, you know, looking at the larger picture here, economic signals are mixed. Consumer confidence is up. We saw that yesterday. Inflation is down from a record 40-year high, but overall prices have still surged nearly 18% during Biden's term, with a 29% spike in gas prices. That's according to factcheck.org. Real weekly earnings adjusted for inflation are down 3.4% despite a touted robust labor market. Layoffs persist. I mean, we saw UPS cutting 12,000 jobs after a wage increase union deal. PayPal set to lay off 2,000 employees. Mainstream media faces, to quote Axios here, a bloodbath of job cuts. More and more Americans, I think, are waking up to being fed a false mainstream narrative and are turning to independent sources for the truth. So the big question here, could the current consumer optimism be driven by hopes for rate cuts this year, even though the Fed held rates steady today? And are the layoffs yet to be fully recognized?
Well, I think, can we trust the numbers is the real question. I mean, the unemployment rate really is a metric from the Great Depression. And so the governmental numbers are being produced by the government and by partisans in a lot of ways. And so I'm not on the fringe here, and I'm not a conspiracy theorist, so we'd like to believe that they're somewhat accurate. But when you look at what's going on with real Americans on Main Street, it doesn't matter if you work at the convenience store or if you own it. Everybody's buying less. Everybody's concerned about inflation, and everybody's not happy with where they were 3 years ago because prices have skyrocketed across the board, even higher than the percentages that you've mentioned here. And so at some point, though, we're going to see an existing softening, and that softening is continuing because the average consumer at Target bought 3% less than they did last year, and that doesn't keep up with inflation for the holiday shopping season. And so maybe we were flat or to the negative, excluding inflation and the cost of goods and things that people bought during the holiday season that just recently passed here. And so I think that the real numbers haven't matriculated through yet. The lag effect has been delayed on what the real economic data is going to show us because rates really have plateaued. The Fed probably should have went up another one to two rate increases, 25 basis points each, maybe raise another half a point. But they decided not to do that because they wanted to maintain the business cycle. But we are seeing slight softening, like you mentioned, but it really hasn't come through the numbers. But when you talk to Main Streeters, and it doesn't matter, wealthy, poor, middle class, they're all going to say they're buying less, and they're tired of how high prices are at the grocery store and how high prices are when they buy things that they need to live. And that's a problem that's going to get worse over time, unfortunately, in this environment. The Fed can't control that.
Yeah, we've also seen credit card debt hit record highs as well. When do you think the first rate cuts of this year might happen?
Well, I think it all depends upon when we get to that 2% 12-month number. And so, if we're floating around 3.7 right now, I don't see it happening before August to September potentially, based on the current transgressions of economic data and how things are starting to soften out, so to speak. And so I think it's going to take a while because, look, the real problem is what's causing all this inflation. The government is spending $2 trillion more than they collect in tax revenue. It's mathematically impossible to have a recession when the government is spending 8.5% of our GDP on the overspend on money they don't even collect. And so you can't have a recession in that environment. You can't have bad economic data in that environment. And what ends up happening is it's a very oblique form of stimulus, not too distant from quantitative easing and the Fed digitizing those treasuries into currency to give to Congress to spend to enhance the economy. And so the government is becoming the ultimate economic pacifier in a socialized economic state by spending that much money. And I think it's skewing all the numbers.
Yeah, the government spending is no doubt inflationary as well. Jeffrey Small, president of Arbor Financial, thanks for your time and insight today. Appreciate it.